Hello everyone, this is Dinesh. Today we are going to discuss the two more new concepts in our strategy. These concepts are really going to help you in identifying 100% win trades or win setups. There are chances that you might go wrong in identifying a setup and you might take an invalid trade and you might end up having a loss. So that is when you put your emotions in and try to immediately recover the trade and to make sure that you don't go into losses. The problem is here with the binary options is if you win the $100, it will boost your confidence and that will make you to go overconfident, saying that I had 3 wins in a row. I am sure that my eyes has got the vision to make sure that it's going to get a valid setup all the time, and you might end up taking an invalid trade because of the emotion that is carried out from the previous trades. Another example is if you lose $100 or 100 units of your currency, and then you find that okay, I'm losing $100 already, and there are 3 losses in a row. So then again, you don't visualize the charts as clearly as you generally do in a calm and peaceful environment, and again there are chances that you go for doing an invalid trade. So the binary options is such a tricky business. To succeed in this, you have to control your emotions. The first thing you have to have is to have a money management, and the second thing, even though you have money management, you need to have control on the trades that you're taking. So we have the signals, we have the strategy with us, the best strategy I can say, nicely working, and you're all testing it and you know for sure how it is working. So we have money management, which is fairly easy to understand, and we already have seen that in our due course of doing demo now. But still we might go into losses. Sometimes the market behaves funny way, sometimes you identify an invalid setup, or sometimes you found out the setup is good and you didn't see the news, so there are chances that it might go wrong. So in that situation, we need to recover the trade or recover the loss that we encountered. So these two concepts that I'm going to tell you today, or make you aware of these two concepts, it will really help you a lot in recovering your trade. If you follow this concept, you might end up having 3 to 4 trades in a day, or sometimes you only see two trades in a day, but still that is enough to happily grow your account and take 100% sure trades rather than losing it and then recovering it, or then losing it. It can be sometimes there are chances that price will not act according to what we expect as per the strategy. So now this is the place where we have to look for other options of making sure that the trade is safe or not. By following the rules of the strategy, we are sure that the trade is safe, but still we wanted to make sure that these two concepts are involved in taking the trade, and then we can nicely and happily grow your account and be safe and secure. So the first two concepts that I'm going to talk to you today is, I'll write it here so that you understand. Divergence, so it is called divergence, and the other is called over areas. I'll first go with the over areas because it's very easy to understand over areas. So what exactly over areas means? Over area is just a word that I use, but it is either called as overbought or oversold. This currency pair, or this commodity, or it's not commodities, it's a currency pair. This pair of currency can sometimes be oversold or overbought. So what does that actually mean by oversold or overbought is identified using some standard indicators. You'll be surprised to listen or to understand that these indicators were framed by great analyst Gerald, and what that I'm going to tell you in a minute. Gerald Apple and one more scientist, I'm not getting his name, Welles Wilder. So these two scientists, or not scientists, these two traders, probably technical traders, identified these patterns in the currency pair, and then they invented these indicators. and these are indicated. These indicators are invented in the year 1970s. It's not when we have modern computers, or not when we have amazing platforms like MT4 and all. They were done manually, and they identified the patterns, and then they found that we have to write the indicator and to calculate that pattern in such a way to identify them. So that is how they invented it. So I'll go through in a minute. So let's talk about over areas first. So there are a few indicators which can be taken as standard indicators, like RSI, relative strength index, or CCI, commodity channel index, or stochastic, and so these three are generally used to identify if the current price for this particular candle or for this particular chart is oversold or overbought. I'll take you through in a minute. So let's go to stochastic oscillator. So the standard is 533. So or you might see something else. It's just 533 that we use at the moment. So 533 is one of the settings that we use, and we just set the MA method. It's called moving average method. Set exponential and set OK. So you see here, this is the way it is represented. You might see the colors to be different. I just use this white and gray just to identify, but if you wanted to use something else, you can use it. So this one is called the real oscillator. This is called signal line. So you can see stochastic time and signal. So this is called main, sometimes called value, but it's called main line and signal line in terms of coding. But this is stochastic oscillator. So I don't go into details of how it is drawn and why it is drawn like this, but I'll just explain you to understand what can we do with this, or what can be identified with this. I'll just change these things. This is too sensitive, so this is best sometimes to understand. So see here, 80 and 20. If the line goes beyond 80, it's called overbought, and if the line goes below 20, it is called oversold, which means that in a given time frame that we set it, a price will never go or stay for more than probably X minutes, or it's not sure, it cannot be guaranteed, but generally it's said that if the price goes to overbought or oversold areas, it is definitely going to return back into the zone of 80 and 20. So if you see here, the price went to here outside the 80, stayed here for some time and came back, and again it went up, stayed here for some time, and it came back. So it tries to oscillate, the price oscillates in between this area, and this is very probably today is a different day because being a Brexit, but generally you will not notice this much of time staying in the market. Let's go to H4 chart and see how it behaves there. So anyway, let's stick to the same, and then let's move forward to see how it is behaving. So that's the stochastic. Let's go to our settings just to make sure that we are now same line. So see here, the price went. So when you see this signal line crossing over, that's the hint that the momentum or the price is done and it's going to change its direction. So it's changed direction. And again, when you see the white is crossing over, then that's a hint that the trend is going to change its direction, so it goes up. And again, if you see here, the cross happens and it goes down. Like that, if the cross happens, it should go up, but no, we cannot say anything about the market, so it went down. But that's generally we have seen. We see that this is the crossover happened and the price might change, or it's not guaranteed. It's just an indication that the price will change. But what we are changes direction. I mean, what we are need to concern is if when we see and when we get a signal line or when we get an M line, we have to make sure that the stochastic or any oscillator or any indicator that you see, maybe an RSI or anything that you see, make sure that it is in the oversold or overbought areas. For example, if I use an RSI, 14 period, and let's say close. So let's have a look. If you can see any place where it's overbought or oversold, you can note. That's too sensitive. The standard will be 30 and 70. So this is the level. Let's take the stochastic for a timing. Let's delete the indicator, and you see here, you can notice here, the price generally stays between these two, 70 and 30, not more than that. Just try to understand this. And when it goes down, or when it is oversold, it won't stay there for a long time. It just bounces back. And when again it comes down, it won't stay for a longer time. It just bounces back. So RSI is my favorite. I generally use RSI to identify whether the price is in overbought or oversold area. So so if you see here, it went up. So the chances here that the price is definitely go down because it is already in the overbought area. So because our strategy is based upon reversal, and we worry about price reversal, so, and we are concerned only with the price reversal. So the main thing to see, if the price, when you get a signal, suppose we got a signal here, so for example, if you got a signal here, sorry, so let's say that is M line, and so let's say here, so you got a signal here, that's the signal candle, and then because so the immediately what you have to check is the price above or not, oversold or not. Yes, it looks to be oversold here. Okay, let's not this one. This is a bad example. Let me say, let me take you this one, that one. Yeah, this is a good example. So the candle happened, that's the M line. So now this is a signal candle. So now let's check, is relative strength index showing that the price is in overbought or not? Yes, it is it's more than 70. Yes, it is. So that is the place where you can say, yes, the price is going to go down. 100% sure that the price is going to change its direction. So you might lose in this candle, but it goes back. So you can win in the next candle. I'm not saying you to martingale, just giving an example. Generally, when you see an M line, you make sure that you have some pivot lines or some barriers, some sort of barriers, to make sure that it's going to help you. So that is one thing that you have to check for. And the second thing, apart from the strategy, you make sure that the RSI is showing you the price is already overbought or oversold, and the momentum of the price will definitely is exhausted and it's going to go back. So that's one place of understanding it. So this is one concept which is called overbought or oversold. You can use RSI, or you can use commodity channel index. It's all a what is it? What's it? CCI. Yeah. Again, the same thing for the CCI. You can have 150 and minus 150, and you can see if once it goes up, it's guaranteed that it's going to go down. So that's like that. So if you see 150, let's it's confusing to you. I will change the levels. So here, so 150 and minus 150 are the standard ones that you get when you open CCI. So commodity channel index, one of the most powerful indicators, like RSI. So you can notice here, it is also see this one, the trade is already in the overbought or oversold area, and it is guaranteed that it's going to go down, or it's going to come back into the normal zone like this. So this is the normal zone, and this area and this area. So this area and this area is overbought and oversold, and this is the nice, or the place where the price should generally bounce back and come back, go again, come back and go again, and so that's the boundary for the price. and if it is more than that, we are guaranteed that it's going to come down to the same area. It can stay there for a longer time. So that's how we understand and say, yes, it's already in overbought and oversold areas, and we are happy to take a trade in that particular setup. And make sure, one more important thing, CCI is showing here overbought, and suppose the M line is formed here, and you don't see any barrier there. So let's say this is the M line. So this is the let's say this is the M line. So this one, and then you see immediately, you see RSI. Yes, RSI is outside of 70. Okay, it's overbought, and there is a barrier which is somewhere here. Let's say there is somewhere here, and then you find, okay, because it is said that the price is definitely going to return, and this RSI is showing more than 70, and CCI is showing more than 150. It's a good sign that we can trade. No, don't think like that. These two are almost the same way in representation. If you see a main barrier and if you see a complementing barrier, that's a good chance of reversal. But if you see that the two standard indicators are showing something overbought, that doesn't mean that they are going to help you as a block, as a barrier. It's just representation of the chart movements, that's all. So don't think that it's the same data that is being represented by two different indicators, that's all. So once if you see CCI is showing high, RSI is showing high, you can see even this, I'm guaranteeing you this, in this place the stochastic will be showing high. See here, the stochastic is also showing as overbought and oversold here. So these three are just a representation of the same data, but in a different way of different calculations. So don't think that this is showing, and this is showing. Let me trade in this candle with even though the barrier is somewhere here. Then you are going to lose for 2 more trades. So follow the strategy. The first thing is to follow the strategy, what the strategy says and what the rules of the strategy are. If the M line is in here, and that is the M line, and then you immediately see a barrier, and that's the point where to check, is this outside the stochastic is showing RSI, any of it is showing you that this is the price is already in the overbought or oversold region, then yes, go for a trade. It's not that don't go assuming that these three are showing but definitely the price is going to return. Don't think like that. It's not going to happen like that. It's just the same data. I'm again stressing the point. It's the same way or the same data or the same market condition being shown in it by 3 different indicators. That's all. So that's one point, one of the concepts. Just make sure that you understand this very nicely, and you can, after you seeing this class of this video, just go back and check yourself how the charts are formed, and you can see or notice yourself the price won't stay for more than longer, and it is quite very useful to understand. And generally people like us who trade on the reversal strategies make sure that the price is already in the overbought and oversold area to avoid any losing trades. So that's one concept. So the next concept is divergence. Let's go back and delete the indicators here. Okay, now we have divergence. What is divergence? Divergence, as you understand, it's just a terminology that is used by traders called divergence. They might, when you are talking to a professional trader, they might say, I had traded this with a divergence, or this is a good setup because there's a divergence in the trades, in the price and the indicator. So what is divergence? You cannot say putting your hand in a slope and say it is divergent to the, so to what? When you see something, it's divergent to what? Let's say I'll draw here, you'll understand here. If I say I'm drawing a slope here, so when you say it's a slope, in relation to what? It is a slope. So which means that you're trying to make sure show that there is something, a horizontal line, and to that horizontal line there is an angle, and that's a divergence. So some sort of, you know, clear picture of divergence means in relation to what. So that the standard indicator that was developed is called MACD or MACD. It is called moving average, convergence and divergence. If you don't know, but it is the most famous and quite nicely used by all the traders across who are trading any sort of trades like price action trades or reversal strategies, or who, if you ask any person in the forex industry and say them, do you know about RSI and do you know about MACD, and if any of them say they don't know, then probably they are not professional traders at all. Everybody in the market, they know about MACD and RSI. Without these two, I'm guaranteeing you that there will be no person in the forex industry can survive for this long, or at least for 5 to 6 years. Very famous indicators and very, very, very nice indicators. Now I'm going to show you the MACD. Let's take the MACD. There is a MACD that comes with MetaTrader 4, but I don't use that. I use 0 lag MACD. And the initial settings will be like this: 12, 24 and 9. Change it to 5, 13 and 1. So it comes like this. So how do we identify that there is a divergence? I'm not going to talk you in detail what those three parameters are how is this represented. This is when you install your MACD in your MT4, you won't see this. You will see something completely different, but don't worry about it. I'll show you this indicator and you can use this indicator. So what's basically this representation? Don't worry about this representation. This video will not talk about why this is represented and how it is represented. Try to understand the concept behind it, and I will take you through take you to there. So when the price is going up, you can see here the price went up in this situation. The price went up here, so this also goes up. So the price directionally like this, and likewise the indicator direction also like this. Suppose the price is going like this down, and the indicator shows you that there is a down. So that is how it is generally being calculated. So it's called MACD, moving average, convergence and divergence. So it's called by moving averages, basing upon moving averages, it calculates. So not a big deal. So like again, you can see here, you can see a slope like this, going the price going down, and again in the same situation the price goes down, and when it goes up, it goes up. But if you observe closely, there will be some places where the indicator will be doing something else, and the price will be the movement of the price will be something else, something else in the sense in some other direction. I'll show you. So let's pick up a place. Okay, see here. Let's take this window. Okay. You can see here the tip or the bottom of the candle and the low price of this candle, closing price of this candle, is in this direction, somewhere like this. But you see in these two lines, the MACD shows like this. So the tip here and the tip here. Actually, there's some technical term for these two things, but don't worry about this. We just call it as peaks. So the peak here and to the peak point here. If you join these two peak points, you form a line like this. And whereas if you join this close or low of the candle to the low of this candle, you can see that there is a clear divergence or clear slope in this way. So the price is trying to move in this way, in this direction. So if you notice anything like this, that there is the indicator shows you that the two peaks of the indicators like this, and the two peaks or the two lower lows or the two lows of the candle's price action is like this, then it is said or it is guaranteed that the price is going to change the direction or be in the direction of the MACD indicator. So now you can see in this case, the moment there is a divergence, the price changed, and see how it's changed. 1, 2, 3, 4, 5, 6 minutes, or which is like 6 into 5, 30 minutes, the price just kept going up until it comes to a consolidation point and then it closes down. So like that is the place where we identify that there is a divergence, and only then we trade. So these two concepts, if we apply these two concepts in one particular trade, then it is guaranteed that the price is the trade is going to be 100% sure of winning. Sometimes what they tend to do, the traders or our live members, they see a divergence and they go for a trade, and you might lose. But because there is a massive divergence like this, if you see a very big divergence like this, then which means that the price is definitely going to return back into the same reverse to the direction. So they go for martingale. So it all depends upon the trader's choice. They might say, okay, I won't trade in this setup. I might increase the lot size in the next setup when I see a massive divergence again. So we just got a message from let's see, from our live traders. They're showing a divergence there. So here is a trade just now. So he found that there's a divergence here like this, and the price is at here. So he traded because the indicator is showing downwards, and the trade here is going to we are going to trade in the put direction, and the indicator is showing in a put direction. So he traded and he won. So it's a live trade. It just happened now. So that's one way of identifying a trade in a live setup, making sure that the rules will be satisfied. You first thing is to see whether the rules are completely satisfied or not. Yes, it is satisfied. Then you look for these two concepts of overbought or oversold area, and the second is divergence. That's very important to identify. And so now the point is, see, we are taking these charts which are already formed, so we know that this is a peak. For example, we are in this candle, and obviously we don't know what's going to happen in this candle, and we see, okay, now there is a divergence here. Massive divergence. So what's going to happen? Shall we start trading in the reverse direction? So then what happened? Again, the price went down up to here. Obviously, this is not the candle that it's going to stop. So we change it. We change it here, and again we see, oh, again, yeah, there's a good divergence. So we can trade in this candle. So because the candle is not formed, we don't know whether there's a divergence or not. So what is the candle that we have to look into? That the candle is the signal candle. Once if you see a divergence at the signal candle to this indicator, then go for a trade. For example, in the same example, you see here that this is the signal candle, the white signal candle, and it is here. So, but the problem is there is still a divergence even in this white candle here, which is not just the candle before the signal candle. Even this candle is also having a divergence because the price is going to go high and the indicator is showing to go down. But again, it just went up. Like I said, our M line is a point of attraction and at the same time point of repulsion. So that's the beauty of M line. See how even though there is a divergence, it still attracted the candle you see the price movement. It's bigger than the average price movement that you can notice here. It just boom. It just went up, and then immediately it formed the M line, and then it just rejected because there is already divergence, massive divergence here. So that is how we identify. So the first thing to understand whether this trade is in overbought or oversold area. Yes. Second thing, just go with the divergence. Is the divergence still there? With these, how do you calculate? Just see the place or the peak point of the signal candle and to the previous peak point of the candle of the price point of the chart, and then identify that there is a divergence, and then trade in the direction of the indicator. So for example, if the divergence is up and you see signal here, which means that it doesn't mean that it's not safe to take a trade, but if you want to be 100% sure of taking a trade, then always take a trade in the divergence scenarios. Then if you take, like I said, you get 2 to 3 trades, and probably in a day, that is enough for us to grow account. Let's go and have a look if I can find anything like divergence in this situation. So here is the candle. So in this situation, you see, if you apply the rules, there is a left price movement here. There is a left price movement. Area 1 is nice. Area 2 is also good. And do we have anything like barriers? Probably there are no barriers actually. So in this situation, it's an invalid setup, but it just don't worry about these barriers. Let's say there are barriers here and there, nice barriers here, and R2 H4 is here, and the price the close is somewhere here, and then immediately you see a barrier. So let's assume it's a good setup, and this is signal candle. And now let's see if there's a divergence or not. So here this is the peak, and the next peak is here. So here is the peak. Sorry, here this is the peak. Okay, so here is the peak, and here is the peak. Oh, then there's a divergence here. So you can notice here the next peak. Sorry. Here. So you see here, so the price is going up this way, and the indicator shows no, the price is have to go down because there is a divergence here. So when you see this place of in the signal line, yes, there is a divergence, then just take a trade and you win. So always remember, first thing, follow the rules of the strategy, the complete rules of the strategy as they are, and import or use these two concepts of divergence and overbought oversold areas to use and find a nice and valid setups. Just go back to the same video again and again and identify some MACD using MACD on your charts. Identify there is a divergence and when the candle is going to return, and so that kind of analysis. So if you see here, I could clearly see there is a divergence here. See here, this peak here to the here, and whereas see here, so this candle, from this candle to this candle, it's a massive divergence. See, not you, sorry, here. See here, it's a pretty much very good divergence here. So obviously this candle should return, should go back, and it did. So we won. In fact, I mean, we didn't win, but because there is no M line or anything. But just showing you, the price will definitely go back, because when you see a divergence, the price just follows the indicator. So use the settings 5, 13, and 1 in MACD, and just see yourself if there is any divergence or not, and use RSI to identify if the trade is in an overbought or oversold area. And sometimes one of the settings that our traders use is 533 in stochastic. 533. That will also tell you if the trade is in overbought or oversold area or not. Yes, it is. So then happily you can go for a trade. So like that. So these are the two concepts. So make use of these two concepts and trade in the 100% sure trades, and make sure that you always improve your win ratio, and wish you all the best. The most important thing, if you wanted to learn about how the indicators are developed and why the indicators are developed, my mind is to understand why, and behind the reasons why they have to work like that, and what is the reason that the scientists or the inventors wrote the indicators in such a way. So basically, I'm into technical analysis to understand and identify why they are written like that and why should it work like that only. So that like that kind. So I generally go deep into the indicators and find out what does it do, and write my own stuff and doing some analysis on it. If you're interested, just Google it, and I can help you in understanding the indicator if at all you wanted to. But general tendency or the notion is to use MACD. Sometimes you can use stochastic or you can use RSI. I prefer RSI to stochastic. You can use RSI with the 14 period to see if the trade is in the overbought or oversold area. So with that, and if you find divergence, then sure short trade. You can happily make it 100% sure trade, and you can trade on that. It might take you some time to get understanding of how to identify divergence and how to draw between peaks, how to identify the places of divergence and all. It might take you some time to get the concept, but just go in the direction to identify the concept of divergence and how to draw it and how to calculate it. It will really help you in the long term, and you will be a sure shot good trader and keep your account always green in money, always in the money. So wish you all the best, and I hope you understood the concept here. If you don't understand, go back and see the video again, and even then you don't understand and you got any questions, you can ask me in the group, and I'm always there to help you. Thank you, and I wish you good luck again.